All right. Well, thank you so much, everyone, for joining today. Welcome to today's webinar, Mastering Your P&L, Unlocking the Power of Practice Financials for Success. My name is Kale, and I'm one of the analytics managers here at IVET 360. Now, for those of you that are not familiar with IVET 360, we provide a range of services designed to help veterinary practices. We want you to be your best. So we offer analytics and finance, HR support, marketing, and now bookkeeping services. And our mission here is to educate and help hospitals identify and implement sustainable solutions. We want to propel your business forward. Essentially, we want to help you help more pets. So today, I'm excited to dive into one of the most powerful tools we have for understanding and growing a business. That's the profit and loss statement. Now, whether you're brand new to financial reports or maybe knee-deep in spreadsheets, I hope to share insights that help drive success today. And just a little background about me. I've been in the veterinary industry for about 14 years or so, on and off. I was a kennel tech way back when, then a CVT in both GP and specialty surgery. And now I'm on the business side of VetMed with veterinary analytics. And really, I'm genuinely excited when the data and insights that we're able to present here at IVET 360 help you, our clients, make more informed decisions about their business. Also, I'm going to introduce Devin, who's our Director of Analytics. He's going to be moderating today. So please note that all microphones are muted for this call. And if you wouldn't mind staying muted, that'd be great. So if you need to ask a question or need anything in general, chat is the best way to go. All right, so let's go ahead and take a look at our agenda here today. So we're going to start by answering a basic question. What is a P&L, or a profit and loss statement? I'm going to walk you through what it is, how it works, and why it's a critical report for understanding the financial health of your business. Then we're going to go explore why the P&L matters and how a well-managed P&L can help you make smarter decisions, improve that profitability, and run a healthier practice. We try to avoid them, but mistakes do occur. So we're going to look at some common mistakes and see how we can avoid those going forward. And then from there, I'm going to break down the core components of the P&L so you understand what each section means and how it ties back to real activity within your clinic. We'll then shift gears a little bit into setting up a P&L, how to structure your accounts for clarity, and what increased detail can unlock in terms of insight. Then, what does all of this insight lead to? That's where I'm going to talk about EBITDA. What is it, and how do we measure it as it relates to your bottom line? Beyond EBITDA, we're going to touch on some common red flags in your financials and how to diagnose problems early before they become bigger headaches. And finally, we're going to wrap up with some strategies to optimize your bottom line. These are practical tips and tools that are going to help drive gains within the practice. And at the very end, we're going to leave some time for Q&A. So if you have a question, go ahead and jot it down and we'll tackle them together. Feel free to add those questions along the way into the Zoom chat. Devin's going to keep track of those for you. All right, so let's start with the basics. What exactly is a P&L? A profit and loss statement, also known as an income statement, that's defined as a financial report that shows your business's revenue, expenses, and profitability over a specific time period. Now, that time period could be monthly, it could be quarterly, or even annually. I like to think of it as more or less a financial roadmap. It helps you understand, hey, where is my money coming from? Where is it going? And most importantly, how healthy is my business really? And why does this roadmap matter? Why do we have a roadmap in general? Well, we can't improve what we don't measure. A well-managed P&L helps us A, identify trends, B, uncover areas of opportunity, and C, zoom in on those details to help your bottom line growth overall. It shows us if we need to focus on revenue growth, maybe cost control, or a little bit of both? And while it can feel like this is all about numbers, which can get overwhelming, I really like to think of this as strategy more so. So your P&L helps you benchmark performance, set realistic budgets, and ultimately know if your business is thriving or simply surviving. And we're adamant in saying that utilizing the P&L, it needs to be entered specifically for consistency, accuracy, and most important, we want things entered in a timely manner. And it becomes increasingly difficult to measure success if we don't have that whole story. Now, where does all of this valuable insight come from? It really comes from one place: accurate, up-to-date bookkeeping. Your P&L is most often generated from an accounting software like QuickBooks, but that magic only works if the data going in is clean. So that means that we have invoices, income, other expenses that should be entered consistently each time. And that's why a skilled bookkeeper is your behind the scenes VIP. They make sure that the financials are accurate, timely, and actionable. Now, I know that many owners and practice managers, they're wearing multiple hats within the business, and due to the sometimes time-consuming nature, but very high importance of bookkeeping, I'm going to recommend that you check in with iVet 360's bookkeeping team if you need an extra hand. They're great. Now, your P&L is more than just a report. It's a tool for making smart decisions, spotting problems before they grow, and building a business that's not just busy, but it's profitable. And while today's focus is really more on the profit and loss statement, it's important to note that other key financial reports in the business exist, one of them being the balance sheet. So the balance sheet is going to provide a snapshot of what the business owns, what it owes at a specific point in time. And some of the accounts like loans, maybe leasehold improvements and distributions belong on the balance sheet, not the P&L. So understanding which report lives where is important for accurate financial decision making. Now that we know what the P&L is, let's walk through some of the common misconceptions and mistakes I see when it comes to managing the P&L. So first step, confusing profit with cash in the bank or seeing cash flow. A gauge of success I see often is equating cash flow with profitability. Just because we have money in the bank or maybe revenue is growing doesn't necessarily mean the business is profitable. You could be seeing large jumps in your income, but if the spending is growing rapidly or even faster than revenue, you're not actually keeping any of it. So the P&L helps tell this full story beyond the balance in your bank. Next is going to be misclassifying revenue and expenses. This is a big one. If things aren't getting entered into the right accounts, your numbers become reliable or unreliable quickly. It's like trying to solve a puzzle where all the pieces don't quite match. And that's where your business consultant cost shows up in labor, or maybe your COGS are ending up in office supplies. With that happening, it skews your margins and distorts really what's happening within your business in certain accounts. And what's worse, it can impact trend tracking, budget comparisons, and takes more time away from other duties as you try and figure out what's going on. So you actually may be over or underinflating cost centers in certain areas. And that's why I'm saying clean, consistent categorization gives you accurate insights, helping to answer the question that many of my clients ask me, hey, are we trusting these numbers and what they're telling us? Next would be not reviewing the P&L regularly. Out of sight, out of mind. Hopefully not. The P&L isn't just a historical document. It's a living, breathing snapshot of your business. And if you're only glancing at it maybe every once in a while, you're essentially flying blind. I like to think of this as maybe a pet's wellness exam. You don't want to wait until the end when something is seriously wrong to check in. We want to get that annual wellness going very often. So at least quarterly reviews are a must, but monthly is that sweet spot. This cadence gives us enough time to react to those changes in revenue, costs, or trends before they they grow into big issues. Plus, regular reviews fosters accountability to help change any ingrained habits that may have started or stop unleashed cash flow crashers. And finally, another big one is leaving out expenses entirely. So every dollar you spend needs to land somewhere on the P&L. If expenses are missing, whether it's inventory, payroll, vendor payments, or sneaky auto renewing subscriptions, that can throw off the whole picture. Again, another little example. Have you ever asked a client how much they're feeding their pet in a day, but maybe they don't mention all the different treats they're giving them? You end up with an incomplete picture of calories. That's the same thing for our finances. Missed expenses inflate your profitability artificially, which could lead to some poor decisions, hiring too soon, expanding prematurely, or even skipping necessary pricing increases. Make sure your bookkeeping process captures everything, even the small things. If it's money out, it should be on the report. Okay, so beyond some of the common mistakes, let's get into understanding the P&L and start with a few of the basics. Like, what are the chart of accounts? These are going to be a full list of financial buckets that a business uses to organize its money. And by sorting revenue and expenses into the right buckets, we get a clear, consistent picture of how the business is performing and where that money is entering and exiting. I like to think of it as a financial scoreboard. At its core, it's going to tell us how much money is coming in. That's going to be our revenue. Where is it exiting? Expenses. And what's left over at the end of the day? Net income. Now, I have EBITDA on this slide, and we are going to be focusing on EBITDA in an upcoming slide since it's a key performance indicator of the business. So we'll be back to it. And beyond that basics, the typical veterinary P&L breakdown could look something like this. So revenue again, variable expenses or cost of goods sold. We have our gross profit, all of your different operating expenses, net operating income, and those non-operating expenses. Finally, net profit, or also called net income. So each chart of account relates to the basic structure of the P&L. There's going to be accounts for revenue and expenses that make up that structure. So now that we understand the basics, how do we get the breakout? And what does it allow us to do? And really, the chart of accounts, that's the foundation for your P&L. It's how all of your revenue and expenses are categorized, and getting the structure right allows you to extract meaningful insights. It might feel like a daunting task, I know, to begin breaking out your chart of accounts from its current version or even starting from scratch if you're a new business. But I like to discuss with my clients customizing your chart of accounts. That's going to give you better visibility into the areas that matter most for your operations. So if you are concerned about spending in a certain bucket, maybe that's labor or maybe admin costs, those are great places to start breaking out that detail. I like to say take bite-sized chunks over time when working on breakouts. So you might start with breaking out maybe one or two areas. And as the practice grows, we may see new expense centers expand. That's going to mean we need more categorization. We need more detail in those areas. You don't have to have every single account from the get-go. I think a lot of people misconstrue that. We don't need that full breakout. Let's just start small and build up. Now, if you're really feeling lost, I know again, this can feel daunting and you're looking for more of that structure and some help. The veterinary standard is the AHA chart of accounts. This version is designed specifically for veterinary practices. It's a framework to help you track more detail, more consistently, and it aligns with industry norms. This is a big tool that iVet360 bookkeepers use to build your P&L, and our analysts help interpret what's underneath that data. So a well-structured chart of accounts helps you track trends, spot outliers, and then trust that data. When accounts are consistently categorized, it's easier to identify, is this normal? Is this not normal? Where do I need to dig a little bit deeper? And you see that QR code there on the screen, that will take you to the website listed. So if you just use your phone, you can go straight to it. All right, so let's walk through the framework of a veterinary profit and loss statement in a bit more detail. So you can see how each section builds on the last to give you a full picture of your practice's financial health. We'll start at the top with the revenue categories. So that's where we break down all the income sources, such as services rendered, wellness plans, retail products, diagnostics, etc. Remember that there are sources of income beyond what's in your practice management software, and those also need to be recorded. I think the biggest one that I see most of the time is going to be online pharmacy revenue. This often doesn't flow through your PIMS, so it can be missed if it's not showing up on your P&L. That's why we like to see it broken out. We're capturing all the dollars that are coming in, regardless of where they originate. Now, due to sometimes us being generous in the veterinary field, for lack of a better term, discounts have their own separate section under revenue. A big challenge we often see is many of those discounts or complimentary services, they're never recorded. That can misconstrue your revenue. So this is an area where it can actually run out of control quite quickly. I say it's best to record any discount. Beyond revenue, we're going to get to cost of goods sold, or COGS for short. And this includes all direct costs of delivering the services that I just talked about that are then resold to clients. So this is going to be medications, lab tests, prescription diets, even some medical supplies. And you can see here, COGS are typically one of the biggest areas of opportunity to improve that profitability. I know from many, many calls with clients that COGS can be one of the areas that feels really challenging. So with that in mind, I'm going to share a couple tips. There are several ways to optimize your COGS. We want to make sure that you are keeping up with those vendor price increases. That's been big over the last couple years. Reduce redundant products sitting on the shelf. Does it do the same thing? Set smart reorder points and stick to a weekly inventory budget. This is one of those areas where even small improvements, they're going to add up. And it's something that our analytics team, we talk about a lot and help practices with. Now, while each practice is unique, we generally see that expenses for cost of goods at about 25% of revenue. But we do see many of our clients perform closer to our 75th percentile benchmark. I'm going to come back to COGS here in just a moment with an example though. Okay, so we touched on revenue. We just touched on cost of goods. When you subtract COGS from total revenue, that's where we get gross profit, or the gross profit margin. And that's money left over to cover things elsewhere in the business. From there, we're going to move on to all of your operating expenses. And this is where a bulk of your costs are going to live. We're going to see things like labor, payroll taxes, benefits, meals, rent, office supplies, and marketing costs. Everything that it takes to keep those doors open. Now, a quick note on labor. We often find that this bucket benefits from extra detail to understand where are costs increasing. Now, labor is typically the highest cost center on your P&L, and it's been a big topic in the industry lately. Good data here helps us understand how staffing is affecting profitability. This is an area where we benchmark at around 40% of your top line revenue, but many practices are seeing those costs increase. Next on down, it's part of labor, but separated out is the employer portion of payroll taxes. This would be the business expense or contributions that land here. And then beyond labor, there are other employee focused costs or fringe benefits. That's going to be our health insurance, retirement contributions, and continuing education. Now, these should be captured in a separate account so that we can see the full scope of the team's compensation. Since we know that a happy team equals a positive work environment, we're going to record all the spending on things like staff meals and entertainment, and those are going to fall under other employee expenses. And it's helpful to split those out so that we can identify areas in case they're growing quietly over time. We don't want people throwing a party every single month. Facility expenses, those are things like rent, utilities, maintenance, and service contracts. Anything that's tied to that physical space. So this is typically the third highest cost center in the business after labor and cost of goods. Admin expenses, now that's going to include things like software, a lot of office supplies, and professional services like accounting, legal, or business consultations. And then finally, marketing costs and merchant service fees, they're going to round out your operating expenses. Then we come back to EBITDA, a measure of the business's operational health. It shows how well the practice is performing from its core activities before the impact of non-operating expenses. Now, I know I keep saying it, but I will break down what EBITDA means on its own slide. It's a powerful tool, and I think it deserves its own slide in particular. So we'll see that here in just a moment. Below EBITDA, we're going to get non-operating items. So these are going to include things like miscellaneous revenue, expenses, interest income, depreciation, amortization, and even some taxes. Items that aren't tied to day-to-day operations, but they do impact your bottom line. And finally, net profit, also net income. You can say either one. What are we left with at the end of the day? Understanding that each one of these sections, revenue, COGS, operating expenses, they're all going to build on top of one another to impact that bottom line and what you're left with. So it's key to diagnosing problems, making informed decisions by looking above. Now, I'm going to touch on a couple examples of trend spotting, mainly around COGS and labor, because I mentioned that they are such big areas of opportunity. Okay, so getting into some spreadsheets. Here we have a list of cost of goods. These are accounts that are broken out quite extensively, and I've highlighted a couple sections here. We can see that in, looks like July, in-house lab costs jumped quite high compared to other months. Now, if all of our cost of goods were running through a single account, for example, I've bolded down there total cost of goods sold. If we have just that single account, it's going to take us that much longer to know where to look and where did that increase come from. So this sort of breakout, while it is quite extensive, it shows us that, hey, we need to go right to our lab costs, identify that outlier, and understand, is this something that was a one-time occurrence, a repeat offender, or possibly a bookkeeping error that makes sense to us that we need to fix? And then if we move into labor, this sheet is going to show an example breakout of labor and payroll taxes, and it's a great reminder that numbers don't just sit there. They're going to tell us a story, especially about our business. So one trend we often see is how payroll is distributed across the year. For practices that pay employees biweekly, you might have 2 or even 3 months where you are going to see 3 pay periods instead of 2. I've highlighted them there in May and November at the top. These months naturally spike in labor costs, and it's important to know that, hey, they are there. When do they occur? So that we're not surprised when all of a sudden it jumps, and we can budget for those months ahead of time. You have to be able to service payroll. So if we wait maybe for a new piece of equipment, let's wait not during a 3 payroll month. And another example would be veterinary tech wages on this page, about midway down the screen. So what we see here is July, there was a jump by about $5,000 per month. And really, that's a flag worth exploring. Did we hire another tech? Did we give raises? Is there chronic overtime occurring? Sometimes the increases are intentional, but sometimes it's an error. And either way, the kind of detail that this shows us here helps us ask better questions and understand what's exactly going on, and it's something can I impact it really. So again, that's the value of breaking down the role and tracking it month by month. It's going to let you see staffing trends clearly, tie them to operational decisions. Maybe you have a new schedule. How is that impacting labor costs? And it makes sure that the numbers reflected are actually showing you what's happening in the business. Now, another little tip here. Let's say 1 month includes a 3 payroll, like in May or November, or you have a large supply order of COGS, like we saw on the last slide in July, but you're comparing it to a normal month, quote unquote normal month, the insights can get skewed a little bit. It's worth asking, does the data reflect operations or maybe timing differences? That context is pretty crucial for making decisions. Is it going to spike 1 month and then go back to normal? Finally, a common mistake we see with a lot of clients is adding net wages to labor expenses, when really it should be gross wages. And don't forget to only add the employer payroll tax costs, not the employee portion. While it's not necessarily wrong from an accounting perspective if you don't do this, if we're trying to make monthly financial judgments, clean buckets are going to be our friends here. So again, this all highlights where we can focus in faster with more detail to make any needed changes. So I keep referencing detail in your P&L, but again, why does this matter? Well, if we have more visibility, we're going to track trends over time, and that's going to be through several accounts or maybe even full categories. You'll be able to spot outliers, whether that's cost spiking or maybe revenue dipping, similar to what I just showed you on those previous 2 slides. You are going to be able to compare yourself to industry benchmarks. That's part of the roadmap to success. And really, most importantly, you're going to be able to accurately calculate key metrics, such as what are my operating expenses month to month. Now, the IVET 360 analysts like myself, we like to think about expenses not so much in dollars, but really in percentages of revenue, because it allows us to benchmark across several practices of several sizes. It's hard to compare a $1 million practice sometimes to a $14 million practice. It gives us a common measuring stick, even when those revenue levels vary. So we want to look at it for efficiency and performance on an even playing field. So I mentioned briefly benchmarking because that's where the value of standardized chart of accounts really shows up. After all, a lot of us want to know, how do I compare? Am I on track with where I thought I would be? Is payroll too high? Are my COGS within range? And I know that every practice is unique. Just know that benchmarks are averages, not targets you have to hit specifically. And the real value is using benchmarks to identify where you're different. Then ask yourself, am I okay with this difference? Is it something I can or want to control? And how do I compare to my own history as a benchmark? Looking at these benchmarks, that's where a financial partner or analyst becomes valuable to help you interpret what those differences mean, whether they reflect something intentional or maybe something that needs more investigation. Now, just important as what should be on the P&L, like we've talked about, is what shouldn't be on the P&L. So I mentioned in an earlier slide, remember there are several accounts like capitalized assets, liabilities, equity, those belong on the balance sheet. So remember, your chart of accounts gives you structure to track well, and benchmarks help you interpret wisely. Together, They're going to create a financial system that helps support smarter, data-driven decision making. Now, this seems like a lot of work. And yeah, it's a lot of work, but what are some of the common reasons we don't see chart of accounts broken out? And what can we do about it? So first, there's a perceived time investment. Breaking out expenses really is it's time consuming and can feel overwhelming, like it's going to take too much time for too little payoff. Second, there's often a limited perceived value. Some bookkeepers and accountants are focused on the big picture, and more granular detail doesn't really offer insight for the effort they have to put in. And finally, those same financial partners, they might feel resistance. If there's no clear reason for detail, they might be hesitant to change what's already working well enough for tax purposes. So this is really where I want you to advocate for yourself. If you're wanting that further detail, explain why you want it. So I hope I've proven the value of having that detail so you can combat any of those arguments above. Now, there is some good news, meaning there are some simple steps that we can do to make things easier. I want us to automate your data flow by importing revenue directly from your practice management system into QuickBooks. This is going to remove a lot of manual effort, also increases accuracy. Use those vendor GL codes. If you haven't heard of those before, the general ledger codes, many vendors, they already have that in the background, and you just need to ask them to put it on your invoices. That's going to help you categorize things quickly. Break out payroll by department so that you can track labor trends more clearly, identify those issues like we saw on the slide with veterinary tech wages. And just ask your payroll vendor to break out those departments and have that breakout going forward. And really, most importantly, prioritize key areas. You don't have to break everything out. Just break things out where you find the most value. By taking a few of these steps, you create a chart of accounts that's more organized and actionable. Now, you've heard me allude to this several times today, so we're finally there. We're going to talk about EBITDA. What does it stand for, first off? It's going to be earnings before interest, taxes, depreciation, and amortization. So that's a big mouthful and really why we say EBITDA instead. And it's a key measure of operational profitability. It's going to strip away all the noise from things like financing decisions, tax strategy, and non-cash expenses. And it's going to give us a clear picture of how the core business is performing. Now, why does it matter? Why do we care about EBITDA so much? It's really what's left over at the end of each month to reinvest into your business. And a higher percentage or higher dollar amount equates to a higher valuation for maybe a future sale or potential partnership. And it's also part of that common measuring stick to compare practices among varying sizes, so industry benchmarks. We can think of it with this simple example. Let's say that you bring in $1 of revenue and your cost of goods are 20 cents. That's going to leave you with 80 cents in gross profit. Then, if your operating expenses are about 60 cents, you're then left with about 20 cents for EBITDA. Equate that to a 20% EBITDA margin. And a couple key insights here. Every 1% decrease in cost of goods or operating expenses directly increases your EBITDA by 1% and vice versa. So this is why I keep saying that EBITDA is such a powerful tool for identifying opportunities to improve performance and profitability. We at iVet360, we focus on EBITDA because it highlights where you can actually make a difference. Unlike net income, which is affected by tax strategy and things that are out of your day-to-day control, EBITDA focuses on what you can control. So again, let's impact revenue, cost of goods, and operating expenses. All of those build on top of each other to get you your EBITDA margin. All right, now that we really understand the structure, how things are built, let's talk about spotting some red flags and uncovering profit leaks. These are the things that slowly drain your bottom line. So we can see here that some of the common flags include high cost of goods. Maybe that's out of line with your past history or industry benchmarks. I'd like to ask, is there opportunity for efficiency in this area? Another one is that bloated payroll, where staffing levels or wages aren't really aligned with production, and possibly they're even outpacing your revenue growth. And some bookkeeping errors, that they miscategorize expenses or revenue. It does happen. For those of you in leadership roles in the practice, I know you're juggling a lot. We have patient care, managing clients, running the business in general. Bookkeeping often isn't the top priority, but these financial decisions matter. So that's why I like to say have a second set of eyes, someone who's really focused on the numbers, and that can make a huge difference. I'll talk with my clients during our monthly calls. I'll ask them, really, is bookkeeping something that you should be spending a majority of your time on? Or would your time be better spent focusing on being the role of a DVM or a PM, helping clients and supporting staff? And then beyond those red flags, we want to catch profit leaks. These are areas of inefficiency or waste, and they might be small on their own, but they do add up over time. So where can we tighten up our spending? Beyond red flags, let's look at some tools to optimize EBITDA. And when I say optimize EBITDA, I don't just mean cutting costs. It means working smarter and being intentional on how we manage both revenue and expenses. So one of the very practical ways is setting up a budget. And most practices that come on board with us, they don't have an annual budget in place. Without one, it's really hard to know if we're on track or if we're veering off course in certain areas. And it's a big part of that financial roadmap, helping you quickly identify unplanned expenses and adjustments before issues grow. This is something that we focus on monthly here at IVET 360. Next, it's going to be focusing on improving margins without sacrificing that care. I mentioned it a couple slides ago, reducing redundancies in cost of goods and keeping up with vendor increases. And with so many pressures from large retailers in cost of goods, where can we improve our margins on things that they can't match? Now, on a quick side note, a little bit of a topical side note, since we're discussing COGS, many of my clients have been asking me, what do I need to look at when it comes to the recent tariffs? So I like to say, identify which supplies or equipment are subject to those tariffs, i.e. imported surgical tools, medication, supplies. Talk to your vendor reps about potential price increases or any known back orders. And for efficiency, I really want us to work with the inventory team to avoid overstocking items to beat a tariff increase, especially if they have expiratory dates. And just make sure to review vendor invoices periodically, compare them to historical data so we can catch any creeping expenses. Then there's the revenue growth. We've talked a lot about costs today, but there's always the revenue side, which dictates a lot of this. So by reviewing financial trends each month, we open the door to key conversations. Should we consider a fee increase if it hasn't been a while? How is our revenue mix shifting? Meaning, where are our dollars actually coming from? Is that what we want? Those types of discussions highlight team contributions as well. Do we have similar consistency and compliance among DVMs through that revenue mix? What about support staff? Are they united in their messaging to the clients about the importance of these services we provide? because all of these efficiencies lead to the goal of veterinary medicine, which is to help more pets. But it also positively impacts your bottom line as a happy byproduct. And finally, we look at expense control tactics. What are the opportunities to manage more effectively? So this is about strategic cost management, not cutting for the sake of cost savings. Where does it make sense for us to cut costs versus how we operate? That's where the P&L can help point out those areas. We saw that detailed cost of goods breakout. So we're not just guessing where to focus, we can actually make decisions based on data. This is the power of great detail. So your P&L tells us your cost structure, how it behaves, and how revenue is growing. Things like rent, those are fixed costs. They're not going to change month to month, really. Variable costs like COGS or certain labor accounts, those are going to grow when you get busier. So understanding this relationship, that's going to help us forecast what happens to profit when you grow, or potentially if we contract. So remember, at the end of the day, revenue is great, but profit is best. So we covered a lot here today, but before we get to questions, here are some key takeaways to wrap things up. Are we keeping up-to-date books to make up-to-date decisions? We here suggest reviewing reports, often for trends and accuracy. We really believe a bookkeeper is worth their weight in gold to help ensure accuracy and allow you to focus on patient care. Expanding those chart of accounts, it's going to lead to visibility and finding opportunity much faster, greater detail to find opportunity faster. And establish a budget. That's going to help you on your financial journey. Now, if this does seem overwhelming and you still feel like you need help with it all, I would consider analytics services and or bookkeeping here at iVet 360. We can give you a hand. So I really, really appreciate everyone joining here today. I hope this information was useful and helps you on your path to financial success. And make sure that you come back next month. We have a webinar, Beyond the Resume, How Behavioral Interviews Improve Veterinary Hiring. That's going to be on May 20th, same time as today, so 10 a.m. Pacific, 1 p.m. Eastern Time. And with that, we would love to hear from you. If there are any questions from today, feel free to put those in the chat. I'm sure Devin has been checking those out, so I'll do my best to address any questions. Devin, do we have any questions here?
All right, just as a reminder, as Gail said there, if you have some questions, go ahead and put those in the chat. We do have a few already there. I'll go ahead and get started here for one question. Gail, you'd mentioned some things that should not be on the P&L. Where should sales taxes go?
Sales tax. Okay, that's a good question. A lot of the time that does actually land on your P&L. And what I would say is every state is a little bit different, meaning what is considered the end user for sales tax. So by state, it could be, all right, the veterinary hospital is the end user, therefore you have to submit that sales tax, or it could be your client, therefore you're collecting that sales tax and remitting it to the IRS. But correct me if I'm wrong, Devin, it should be on the P&L.
Nope, actually, so it would be on the balance sheet. So if you're paying the tax for, you are the end consumer, the thought there is that would be what would be the use tax. So you're using it.
That's right.
Now, if
Yeah.
you're collecting it from the client and you're going to give it to the state, then that's something that's typically tracked on the balance sheet. So that's going to be something that you're just going to have as a pass-through collection. It's not your revenue, so you don't want to track that in revenue, and you also don't want to have that as your expense because it is just going to be given over to the state that you've collected on their behalf. So that would usually be somewhere on the balance sheet, typically an asset that you're collecting on their behalf, and then you have the liability that you'll pay out. So you don't necessarily have to pay it on a monthly basis unless that's what you want to do, but you're keeping track of that on that side because it's not technically for the practice.
Perfect. Thank you.
Now, another question here is, You mentioned GL codes on the vendor invoices. Um, so I guess that's for the entry part into the QuickBooks there. Could you go into where we would get those codes or what we should ask?
Yeah, good question. So GL codes, again, general ledger codes, those are going to line up with the AHA chart of accounts. So if we think back to that slide with the AHA portion, if you go to that website, you're going to be able to see, all right, what do these codes actually look like and what do they reference? Meaning maybe we have the number 5,000 that references professional costs, professional service costs. Well, that GL code is going to match up with it. So if you ask your vendors to put those on the invoices, that's a quick way to say, all right, as I'm entering things into QuickBooks, I see that it's 5,000 professional service costs. Therefore, I know that it falls into that bucket. Hopefully that answered your question.
Another question here for you, Kale, is if we find that expenses were misclassified in past months, should we go back and fix them or just focus on getting it right going forward?
Yeah, that's a really good question and something that we see quite often. So, what I would say for that one is it depends on what the value is for you. You know, what value are we getting from this breakout? If we want to look at longer term trend spotting over several years, you know, it may be worth that breakout, but I really, really want you to check in with your accountants prior to make sure that, hey, are the books closed? They may not want you touching that. But if they're not closed and you feel like I need this detail, like we saw in some of those slides, you can go back. But if we're feeling pretty good about our breakout right now and where things are living, you might just look at going forward. If we're confident in those numbers, let's just get it right going forward.
Sounds good. Got a couple more questions for you here, Kale. One is, what's the best way to make sure we're not missing expenses, especially small reoccurring ones like subscriptions or auto renewals?
Oh yeah, the auto renewals. We see those quite a bit. So I would say that, you know, during this webinar, I talked a lot about consistency, timely bookkeeping. That's going to be a big thing here. For subscriptions, we want to make sure that they're actually landing in the proper account so we can actually go to that account and see when they land. And then if they pop up, we start to say, all right, is this something that I really want to spend my money on? Do I need to keep this subscription really? So to bring it back, really, it's timely and accurate bookkeeping that are going to help with this and not missing those expenses. Any other
Right.
questions?
Got one last one here for you, Kale,
Okay.
and that is, how do we know what's supposed to be on the P&L versus the balance sheet? I know you touched on it a little bit, but maybe just revisit that.
Yeah, similar to the question we had earlier, right? So with sales tax,
Mhm.
um, basically, when it comes to knowing the difference, I'm going to go back to that AHA slide that I talked about previously. When we look at that breakout, it's going to tell us, all right, here are all the things that are included in the balance sheet. Here are all the things that are included in the P&L. It's not going to be a one-to-one to your practice because, again, every practice is unique, but you know, that's going to be a big one. I would also say that the ultimate source of knowledge really is going to be your accountant or bookkeeper because not only are they going to know about those accounts, they're going to know the tax strategy around them. So, AHA chart of accounts and accountants.
Great advice, Kale.
Anything else?
Well, I think that's what we've got out there in the chat for today, Kale.
Awesome.
Definitely thank you very much
Okay.
for the insightful stuff, and thank you everyone for joining. Um, Again, if you need any assistance with anything regarding what you saw today, we are here and happy to help. Thank you guys very much.
We appreciate it. Thanks so much.